Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. I want to talk about interest rates, and most importantly, I want to talk about 6%, that number. Now, there's a lot of uncertainty that is happening in the markets, the equity markets, the bond market. A lot of the markets are pricing in that we could see interest rates heading towards the 5.5%, especially after Bullard and Mester coming out hawkish than anticipated and talking about that they were looking for a 50 basis point rate hike in the last meeting, and which basically brought shockwaves in the equity markets, and you had some selling, especially after Bullard's comments. Now, markets are pricing in 5.5%, had some selling in the equity markets. The bond market's been selling way before that, pricing in higher rates, especially after the jobs data report. But what does this mean going forward? Are we capped at 5.5%? Could we go higher? Could we go lower? And when I look at the markets and when I look at data, and definitely this can change, right? But today, from what I'm seeing, especially when you look at the last inflation report, which the Federal Reserve likes to look at, which is the PCE inflation. And the PCE inflation, the headline and the core number month over month, came in hotter than usual. If we look at the month over month core number, came in at 0.6 versus 0.4 expected. And when we look at the actual headline number, it came in 0.6 versus the survey, the expected number 0.5. So what has happened, right? Inflation came in hotter than anticipated. It's a number that the Fed really looks at. Does that mean that there's more rate hikes to be done, more than what the markets are anticipating, which is the 5.5%? Could we see 6%? And I would not be surprised. I actually think that we could see 6% in interest rates, especially if the data continues to be strong and hard. If this data continues to be strong and the data continues to be hot, then sure, we could see more of the market pricing in higher and higher rates. Now, the Fed has told us that they're going to raise rates. They're going to raise rates at elevated levels into restrictive territory. We don't know exactly what is this restrictive territory, and we don't know when the Fed is going to end. We did hear from the markets that, hey, the Fed's going to probably end very, very soon. They were going to see rate cuts by the end of the year. And now it looks like the rate cuts are being pushed further out as the Fed and some of the Fed members come out to talk about, hey, we may have to do more than anticipated, more than expected, which brings in that 5.5% number, which is not far from 6%. It's only 2 more rate hikes away from 6%. Now, when we look at the other parts of the PCE components, if you look at non-housing core service PCE inflation, now this number, the FOMC is very focused on the non-housing core services PCE inflation, which you could call a super core, taking out the housing component, because the FOMC did acknowledge that the housing component may be making inflation and the numbers looking higher. So they're going to look at the non-housing core number. And that number has also increased biggest amount monthly in over a year. So it had a very large increase as well, which again, something that the Fed is looking at. So when you look at inflation, yes, inflation, if you look at the CPI numbers, have come down from the peak of 9%. But how do we get to the goal of the Federal Reserve to 2%? How do we get there? Well, let's bring up the Taylor rule. The Taylor rule suggests that if rates are above the inflation rate, if interest rates are above the inflation rate, then yes, you can get inflation down to 2%. If there is also, and aside from the Taylor rule, if there's also a very hard landing or a very bad recession, you do get to the 2% target. So tell me, how do we get to 2% when rates are not even above the inflation level? and everything is fine. It looks like we are still have a very strong economy. The jobs market is doing very well. The unemployment rate is doing very well. That means that the economy can handle the rate hikes that are happening. Which means what? Which means that the Fed may have to increase more rates than expected, and the market may be wrong about 5.5%, and we may actually need more than 5.5%. We may see 6%. I think when you look back in history, especially if you take 1970s, 1980s, when you look back, the rates were above the inflation level. We did see that the Taylor rule was being implemented there. But today, the Taylor rule is not. Now, yes, the Fed doesn't follow, and they are not following the Taylor rule, right? Yes, I do agree with that. They're not following the Taylor rule. They're not doing it as we speak as well, even though Bullard did mention it in his presentation last year. But that doesn't mean that things can't change. And if you take back history of 1970s again, 1980s, especially in the 80s, when Paul Volcker came out, raised rates all the way to 2% and kept them there at high elevated levels for some time, that eventually did bring inflation down and dropped it dramatically and did cause massive effects in the economy. So if we take history, if history was any lesson in the past, and we take the 1970s, 80s concept, we take the Taylor rule as an example, and we know that the Fed is very late to react. The Fed is very late when it comes to looking at data and continues to always be late to the game, always be late. They were late when they were talking about that inflation was going to ease back in 2021. They were late to raise rates. They raised rates way too late. They started in 2022. They should have done it in 2021 when inflation was moving higher and higher and higher. So they were late then, and it looks like they most likely they're going to be late again. That they don't want to make the mistake of bringing rates down too early, which could spike up inflation again, which could again bring rates higher all over again. We did hear Powell say that he did not want to follow in the exact footsteps of 1980s scenario where they had to raise rates twice to very elevated levels to bring inflation down. They want to fight with it now. Now, if they don't do that and they make a mistake, what is that mistake? If they, let's say, decide to pause and then start cutting rates, and if inflation creeps back up again, then that is another mistake that could come down the road if they start cutting rates early and they do cave in to whatever the market is pricing in, and the market and the economy is not as bad as expected, and they start cutting rates. Sure, that will be inflationary, which means they will come back harder to hike rates aggressively. So I don't see a reason right now of why they would cut rates, why they would pause. I see every reason right now for rates to continue to go up. I see reasons for rates to hit 6%, and I see reasons for the interest rates to hit and follow the Taylor rule, because if you look at history over and over again, to bring inflation down to 2%, and if you look at the past, if past was any lessons, if you could derive any lessons from there in 1970s and 80s, you had to bring rates above the inflation level you had to cause some sort of big recession. So there's two things that could come out of this. Number one, something breaks now. In the next 2-3 months, something happens that breaks that, yes, brings inflation down to the 2% level. That's one possibility. Something happens this year. The hard landing that people are expecting. Or nothing breaks, economy still is doing well, resilient, jobs are doing well, which means that the Fed has to hike more, which means that we could see 6%, maybe even higher than 6%. And Once we start getting to that 6% or higher, then it's going to raise a lot of eyebrows and it's going to cause a lot of fear, panic, and definitely it would be very hard to ignore that something by then would eventually break. Something would happen. Yes, inflation would come down because yes, you're creating all this pain from all the rate hikes. But right now, all the rate hikes that we've seen so far, we have seen some effects of it, but it's still not as bad. Look at the unemployment rate, still doing well. Look at the PCE number. Look at the inflation number. Look at the last jobs report number. Hotter and higher than usual. So you guys let me know what you think. Are we going to see 6%? Are we not? Leave a comment below, subscribe, hit the like button, and we'll see what happens. Will be very interesting to see data, especially this month, being the beginning, as we approach the beginning of the March month. We're going to get a lot of economic data, macroeconomic, plus we'll get the FOMC rate hike decision that will happen very soon as well. So let me know what you guys think. Leave a comment, subscribe, like, hit the like button and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.